when we last met, we were looking at the statement of changes in equity of a company, and we're using question 3 of the October 2017 paper. Right, I'll just read through so that we can just have a feel of what we're looking at. Right, the following is an extract from the trial balance of all things on 28 February. Right, we also did all the calculations that were relevant then. Right, office building, World Things Limited owns an office building in Santin, which was acquired on 1 March 2013 at a cost of 5.5, land 1.5, building for 4 million. The property was available for use as intended by management on acquisition date. The useful life of the building was estimated to be 20 years, and the residual value of nil was allocated to the building upon initial recognition. Both the useful life and the residual value of the building remained unchanged. World Things Limited adopted a policy to revalue its owner-occupied landed buildings. Revaluations are made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at year end. On 1 March 2016, Mr. J. Smith, an independent sworn appraiser, revalued the property for the first time and determined the fair value of the land and the net replacement value of the building to be 1.7 and 6 million respectively. The inexperienced accountant of World Things Limited did not account for the revaluation or any depreciation on the building for the current year. So there are two things there that can affect the statement of changes in equity. Number one, there is the revaluation on the land and on the building. The revaluation surplus is part of equity. So we did a calculation in our previous session whereby we determined the revaluation. On the land, we found it to be 200,000. And on the building, our revaluation, we found it to be 2.6. Right. Then the other thing, they said they didn't account for depreciation. Then our depreciation will be 352. The depreciation affects the profit because depreciation is an expense, and profit is part of the retained earnings. Right. Then okay, so those were the two things that we need here. We need the revaluation, we need the depreciation. Right. Then number 2, long-term loan. World Things entered into an unsecured long-term loan agreement on 31 August 2015. The loan is repayable in 6 equal annual installments commencing on 31 August 2016. The nominal interest rate is 15% per annum. Interest for the current year must still be provided for in the accounting records of All Things Limited, and it is payable on 5 March 2017. So here we needed interest. It was still to be provided. And we know that interest is an expense, and an expense will affect retained earnings. So we had to calculate that interest, and we found it here. Our interest, we calculated it, and we found that it was 445,500. Right. So you can refer to those calculations. I'm just reading so that we can be able to refresh to know what was happening there. Right, then World Things Limited was incorporated with an authorized share capital of, right, if we still remember from last week, we said the authorized share capital will not be recorded in the statement of changes in equity. It will not be recorded in the statement of changes in equity, right? But we record the issued. The authorized is simply the maximum shares that the company is permitted to issue according to its memorandum of incorporation. All right. So what we record in the statement of changes in the statement of financial position is the issued share capital. Right. So this one was the issued share capital on 1 March 2016. That is at the beginning of the year. So with these ordinary shares, 10% cumulative and 12% non-cumulative preference shares. Then the following share transactions occurred during the current financial year, and they have not yet been accounted for yet in the accounting records of World Things for the current year. Right, World Things issued 75,000 shares on 1 September 2016, non-cumulative. We calculated those shares and we found them to be maybe we didn't do this calculation. I don't see it here. And I see additional information 3, maybe I jumped it. Okay, maybe let me first go back to 3. Oh, I didn't read 3. Investments. Included investment at year end on 28 February 2017 is the following investment. Wild Things acquired 4,500 shares in a listed company, Lion Limited. The shares are not held for trading, but were acquired with a long-term view. The directors of Wild Things Limited irrevocably elected at initial recognition to classify this investment as at fair value through other comprehensive income. The market value of the shares on JSE Limited at year end on 28 February 2016 amounted to 360,000. The shares traded at 95 Rand per share on the JSE Limited on 28 February 2017. The increase in the value of this investment has not been recorded yet. Right, when shares are classified as investments at fair value through other comprehensive income, the increase in the value of those shares will be recorded in mark to market. So according to this, we are going to record this fair value gain in mark to market of 67,500. Right. Then the issue of non-cumulative, which I was looking for, is this one here. Right. Then on top of that, they also on 31 October, they received the proceeds of 1 million when 600 ordinary shares were issued. These ones, there's no need for a calculation. That means they issued shares for 1.2 million. Then on 28 February, they issued a capitalization issue to all registered ordinary shareholders at 150. A capitalization issue, that means they issued shares for free to shareholders. So we calculated that capitalization issue and we found it to be 855,000. And according to this comment, a capitalization issue, we add to the ordinary shares and we also subtract from retained earnings. Right. Then lastly, there was a dividend. An ordinary dividend of 10 cents per share was declared to all registered ordinary shareholders on 28 February 2017. The company did not pay or declare any dividends during the previous financial year. Right. If we still remember, we said that as long as they declare a dividend, an ordinary dividend, it's automatic that the preference dividend will be paid. So even though on number 5, they're only talking about an ordinary dividend, according to law, there is no way that you can pay an ordinary dividend without paying a preference dividend. So whenever they say that an ordinary dividend was paid, that also automatically means that the preference dividend was paid. Right. So we calculated the dividends. We found them here. These were the dividends that were paid. Right. Then now let's answer our required. Our required says the first one says calculate the profit for the year in the statement of profit or loss and other comprehensive income of Wild Things for the year ended 28 February 2017. We want to calculate the profit for the year. Right. So we'd say calculation of profit for the year of Wild Things Limited for the year ended 28 February 2017. Right. Normally in this module, when they say calculate, that means you're not preparing the full statement of profit or loss. Because normally if they want you to prepare the statement of profit or loss, they will tell you prepare the statement of profit or loss. But if they say calculate, that means there's something. Usually there will be a profit that is already there, but you just have to take into account 1 or 2 things that have not been taken into account. Right. So if we check here, I think we have to do everything because we're just given everything here. So we'd start from our sales. Right. So say our revenue, this one here. And there is no adjustment So just take it as it is. So dev revenue $20 million. Then we'll have our cost of sales. Again, on the cost of sales, we didn't have adjustments on additional information. We didn't have adjustments on additional information. So take the cost of sales as it is, which is the 8 million. Then we find our gross profit. Right. Then we'll have other income. Let me just check if there's anything on additional information. No, there's nothing. Those shares were these shares were at fair value through other comprehensive income. If they were through profit or loss, that gain was going to be included in other income. So just take other income is given, that is 300,000. So it's 300,000 our other income. Right. That's 300,000. We add other income. Then we subtract our expenses. We have admin expenses, 8 million, and distribution expenses, 2.4 million. Sorry, 2.4 million and 240. They didn't have adjustments. So we'll just take them as they are again. Right, then distribution expenses. Right. Then we have other operating expenses. But now on other operating expenses, we've got an adjustment. Remember that we're told on number 1 that the depreciation on the building had not been taken into account. The depreciation on the building for the current year had not been. We're told that the inexperienced accountant of all the things did not account for the revaluation or any depreciation on the building. So to the depreciation, we're going to add to these other operating expenses of 160, would add our depreciation that we had, which we calculated. So to the 160 would add this depreciation for the year on buildings, which we calculated, 352,941. 352,941. Plus the depreciation on buildings, the depreciation on buildings that had not been taken into account. What do we get?
Five million 5,129,41.
Like this.
Yes.
Right.
Yeah.
Right. Then we also had finance cost. They're not taken into account this interest here. So they have finance cost. We calculated it again. We calculated it here. 455,500. Then we get our profits before tax. That's our profit before tax. Then we subtract our income tax expense. Which is given here. 247,1,700. Then we get the profit for the year. That's the calculation of the profit. Any questions?
No questions.
Right. If we don't have any questions, then we'll move on to the next part of the question. We then do part B, using the information calculated in A above. Prepare the statement of changes in equity of all things for the financial year ended 28 February 2017. Right, so we then prepare the statement of changes in equity. Statements of changes in equity of Wild Things Limited for the year ended that's 28 February 2017. Right, so in your statement of changes in equity, you create a column for each and every equity item that is in on the financial statement. You create a column for each and every equity item. Right, like here we should create a column for ordinary shares, 10% cumulative preference shares, and 12% non-cumulative preference shares. Each should have its column. Then we should also have a column for retained earnings, mark to market. And then there was a revaluation from additional information. So all those items of equity should have a column created for them. So we're going to have, normally we start with the share capital, that's the first one. Right. Right. Would have ordinary share capital. Would have 10% cumulative preference shares. We'll have 12% non-cumulative preference shares. Would have retained earnings. Would have revaluation surplus. Would have mark to market. Would have our total. All right, so each item of equity will have a column created for it. So we'll start with the balances at the beginning of year. So you start with the equity that we had at the beginning of the year. All right, our equity at the beginning of the year in terms of shares. These are the shares that we had at the beginning of the year. You have to be very careful. They said here on 1 March 2016 that these were the ones at the beginning of the year. And remember, we don't use the authorized. We include the what? The issued, not the authorized. This authorized is not recorded in the statement of financial position. We record the issued, not the authorized. The authorized is not recorded. It's just shown in the notes to show that the maximum shares that the company has are so much. So we're going to include these ones here. So we have 4,500,000, 900,000, 1,350,000. Right, just a second. Our retained earnings. We have our retained earnings. Were given here, and the mark to market. These were the balance, the balances that were there at the beginning of the year. All right, so it's saying right, we have, let me just $2,400,000 mark to market 120,000. Right, the total, the revaluation surplus, if you can check here, we didn't have anything at the beginning of the year. There was no revaluation. So just put it as a 0 there. Our total, we simply add up everything else. Right. So those will be the balances at the beginning of the year. Then you look at movements during the year. Movements during the year looks at all the changes that happened during the financial year. Right. We had additional shares issued. On the ordinary shares, so you should have noted whilst you were reading, on the ordinary shares, we're told on number 4 that on 31 October, Wild Things received proceeds of 1.2 million when 600,000 ordinary shares were issued. So there's 1.2 million from the issue of shares there, which is 1.2 million. Right. Then on the cumulative preference, then we also had Wild Things issued 75,000, 12% non-cumulative preference shares. So the 12% non-cumulative preference shares were also issued at 4 rand each. We calculated the amount and we found it to be here. We calculated it and we found it to be 300,000. This 300,000 here. So that 300,000 is the value of 12% cumulative shares that were issued. There were no 10% cumulative preference shares issued during the year. Right. Then we will have our bonus shares issued. Right. Our bonus shares, we are getting this information from here. That on 28th February 2017, capitalization shares were issued to all the registered ordinary shareholders at 150 per share at the ratio of 1 ordinary share for every 5 ordinary shares. So a capitalization issue and a bonus issue are one and the same thing. These are shares that are issued to shareholders utilizing the reserves. Right, so here we have, we calculated them. 855,000. 855,000. Right. So these ones, bonus shares, you add them on their category. You can even issue bonus preference shares. You can issue bonus ordinary shares. So these ones are ordinary shares. So we add them under the ordinary shares. We add them under the ordinary shares. Right. And in addition, you also subtract that amount from retained earnings. Why? Because when they issue the bonus shares, they utilize retained earnings. So at the end of the day, the total will be 0. Why? You are just adding on the ordinary shares or the preference shares, whatever shares that are issued, and then subtracting the exact equal amount on the retained earnings. A bonus issue or a capitalization issue is made by utilizing the reserves. Right. Then we have our total comprehensive income. Right. Now let me just explain how we record our total comprehensive income. When you are recording your total comprehensive income, the profit or loss for the year will be recorded under the retained earnings. So we record the profit under the retained earnings. So if it was a profit or a loss, if it's a profit, you add. If it's a loss, you subtract. Here, so this profit here is going to be added here under the retained earnings. That's 6,219,859. revaluation surplus during the year on land and buildings during the year is added to revaluation. Right. If we still remember from additional information 1, we had a revaluation on the land of 200,000 and a revaluation on the building of 2.6. So all in all, we had a revaluation of 200 plus 2.6. So let me just do the calculation of the revaluation. Revaluation, okay, let me just say revaluation on buildings. Which was 200,000. Sorry, it was on land. Then revaluation on buildings. Which was the 2.6, this one here. Right. Then we get our total revaluation surplus. Right, so just 2.8. So this 2.8, we're going to add it under the revaluation. Right, then fair value. Fair value gain on investments classified at fair value through other comprehensive income. So note that we only include it income during the year is added to mark to market. So if we've got any investments that are classified at fair value through other comprehensive income, if they gain, we record that gain under the mark to market. We add it to the mark to market. But if they are classified as at fair value through profit or loss, we will not include that gain under mark to market. It will go in retained earnings. So like in this case, we're told that these shares here, where they received the dividend, they were classified at fair value. If you can check this statement here, they decided to classify this investment at fair value through other comprehensive income. So as long as it's like that, then you include the gain under the mark to market. And we calculated that gain. We found it to be, 67,500. So that's how we record our total comprehensive income. Any questions on the total comprehensive income? Right. Then finally, we then subtract the ordinary dividend. Dividends paid, whether they are ordinary or preference dividend, they are subtracted from the retained earnings. Dividends paid, whether ordinary or preference, they are subtracted from the retained earnings. Right? We are told that because they are a distribution of profit, an ordinary dividend of 10 cents per share was declared on all registered ordinary shareholders on 28 February 2017. The company did not pay or declare any dividends during the previous financial year. Right. So you'd find that here, our ordinary dividends, we calculated it here, 342,000. So we subtract it from the retained earnings. Then preference dividends. All right. If we still remember, we had two classes of preference shares. We had the cumulative and non-cumulative. The difference between cumulative and non-cumulative is that for cumulative preference shares, if they don't receive their dividend for any particular year, they will recover it in future. Whereas non-cumulative preference shares, if they don't get a dividend, then it's gone. So like in this case, we're told that the company did not pay or declare any dividends during the previous financial year. So because of that, these cumulative preference shares were earning now, this year they will earn times two. The one for last year and the one for this year. But this non-cumulative, the one for last year that has already been forgone will not be recovered. So that's why you see here, when we calculated the dividends, we had the cumulative were multiplied by 2. The multiplication by 2, we were multiplying by the number of years, that is 2 years that were being paid. The last year's dividend that had not been paid plus this year's dividend. But this one we didn't multiply because if they are non-cumulative, that means any dividend forgone will never be recovered in future. So our total preference dividend is this 180 on cumulative preference shares and the 180 on non-cumulative preference shares, making it 360. So we would say 180,000 plus 180,000. Would you give us? Again, it is separated on the retained earnings. So dividends, whether they are ordinary or preference, we deduct them from the retained earnings. Why? Because they are a distribution of profit. So dividends are not subtracted in the statement of profit or loss. They are not an expense. They are an equity distribution. So that's why we show them in the statement of changes in equity. Right. After recording all changes, then you record your balance at the end of the year. Right. The balance is at the end of the year. You just add up the figures that you have above there. You just add up the figures that you have up there. So it will just be those are the balances at the end of the year. Any questions?
No questions, sir.
Okay, so if you don't have any questions, then we'll continue next time because I wanted to do the statement of changes in equity, but I see that with the time remaining, it's not possible for me to start the statement of changes in equity. So in our next class, we'll look at property, plant and equipment and the statement of changes in equity. Maybe also do financial instruments at the same time.
Thank you,
So
sir.
enjoy your holiday. Thank you and sorry for disturbing you.
It's okay. Bye-bye.